Welcome to the Property Investors Podcast. Thanks so much for tuning in. Make sure you subscribe so you never miss an upload. You can catch us on Apple Podcasts, Spotify, and YouTube. Enjoy this week's show and don't forget to share it with all your friends.
Hey, I'm Russell Leeds.
I'm Ricci Mandal.
And welcome to the Property Investors Podcast. On this week's show, we're talking, do property prices really double every 10 years? Now, Rix, how long have you been investing in property or interested in property, attending property events, etc.?
Just over 5 years.
Just over 5 years.
Yeah.
And I bet you, at every single property event you've ever been to,
Yeah.
you'll have heard somebody say, property prices double every 10 years.
Yeah,
And have you said it yourself?
I have.
You have.
I have.
And
So what they do is they go, property prices double every, and then I'll finish the sentence, say 10 years.
And you're one of those sheep that goes along with it.
Yeah.
All right. So the question is to you, do you think they actually do? And over what period of time? Because I mentioned to you this, we were going to talk about this. You said, well, surely they can't double every 10 years indefinitely. You know, like the doubling penny. We talk about the doubling penny. Penny doubles every day. And in like 30 days, it's worth like 30 million or something.
Yeah.
And that's a penny. So if property prices really doubled every 10 years, would they not be just astronomical?
Well, yeah. Yeah, they would be. I mean, I think, well, your first question was, do I think they double every 10 years?
Yeah.
And my answer to that is, I think it depends on the area.
Okay.
Because some areas haven't recovered from the crash that happened almost, 7-8 years ago.
Yeah.
So do they double every 10 years? I think it depends on the area.
Yeah. Well, the first thing I would say is, obviously, we can look at recent history and we know that it's not a guarantee that it's going to double every 10 years, right? So let's say in the year 2000 and 2010,
Yeah.
if property prices are on average worth 200 grand,
Yeah.
it's not a guarantee that by 2020 they're going to be worth 400 grand.
Yeah.
It's not a guarantee. But what we can do is we can look back over history and we can look back at the average selling prices of properties in the UK and see if there is a trend where they're going to double on average every 10 years.
Okay.
So what I've done is, with a mixture of Google and ChatGPT,
Yeah.
I've found the average house prices for every decade, so on the year. So starting from 1930.
Wow, you were just a kid then.
Yeah, just a nipper back then. So starting from 1930, 1940, 50, 60, 70, all the way up to 2020. So for 90 years, to look at the average house prices and see if in fact they do double. Because it's very hard to predict the future. But the best way to predict the future is to look at the past, because history tends to repeat itself, right? So I thought this would be really interesting to go back as far as I could. The earliest data I could find was 1930.
Back when you were a kid.
Back when I was just a nipper. Before then, you can't find any more details. I've gone back as far as I can. But I think 90 years is quite a good case study of time to see what is happening. All right. So here are the interesting figures. Do you want to hear them?
Hit me with it.
So 1930. How much, guys, do you think, I'm not going to ask Rick because it's here on the screen, how much do you think a house, the average house price in the UK, sold for in 1930? About £3,000, £500, £1,000. All right, I'll tell you. The average house price in 1930, according to Google, was it wasn't 400. It was £400. £400, all right? So what I did is I've done two graphs. On the one graph, I've plotted the real figures of what house prices every 10 years. And on the other, I've took the £400 and just doubled it, right? So here are the real figures. 1930, £400. 1940, £600. 1950, £1,900. 1960, £2,200. 1970, 4,500. 1980, 21,000. That's quite a big jump there. 10 years gone from £4,000 to 21 grand. 1990, 60 grand. 2000, 93. 2010, 167. 2020, £256,000. Now, if you just looked at the 400 doubling over that time, in 2020, the average house price would be £204,000. So in actual fact, house prices more than double on average every 10 years and have been doing for the last 90 years. So when we're trying to work out how much do we think house prices will be in 2030, quite simple, I'm just carrying on the doubling figure. We're probably looking at £410,000, somewhere along those regions, which really is pretty incredible that house prices over such a long period of time genuinely do double every 10 years. I asked a few people, a few of our team, do you think that since 1930 they've doubled? Everyone was being like, oh, well, no, probably not. They probably haven't really doubled over that period of time. So when you hear it banded around, it's quite interesting that they actually really do double every 10 years. So what does that actually mean as a property investor? Well, we all know that as a property investor, how many times do you get paid?
3 times.
Go on, what are the 3?
3 times are, the first one is you can get it below market value, so it's equity straight away.
Yeah.
Second time is from the appreciation, which would be this. Third way is from rental income.
Bang on, right? So if we look at, say, if you bought a house, capital appreciation we're talking about now, and you bought a house, average house in 2020, right? How much was the average house price in 2020? Bear in mind, this is not a good deal. This is just, you've just gone and bought a really random whatever house. So the average house price we've got here is 256 grand, right? So if you bought an average house on a buy-to-let, how much money would you need for that house? How much money would you need to put in yourself?
I feel like I'm on the eviction again. There's a lot of people listening to this podcast, and I don't want to waste any time. So come and find me on the break, and I'll give it. No, so I actually know the answer now. Fast forward 5 years, I've known the answer.
Go on.
So if you're buying it on a mortgage,
you're buying it on a mortgage, 25% mortgage, just a normal average house. You're not trying to do anything clever. You're not doing it as SA. You're not doing BRR. It's 256 grand. So
okay. So if you're buying it with a mortgage, buy-to-let mortgage.
Yeah.
Buy-to-let mortgage, you need 25% deposit.
Yeah.
So you would need 64.
Yeah.
£64,000
for your deposit
for the mortgage.
Yeah.
Then you would need stamp duty. Now, stamp duty is a sliding scale, but I believe
for a buy-to-let like that, you're probably talking what, 5, 6 grand, 7 grand,
7 grand,
something like that.
7 grand.
Yeah.
And then legals,
couple of grand,
and broker fees. Yeah, a couple of thousand.
2 grand. So you're looking at about 70, 72 grand, something like that, all in. So that's fair.
Yeah.
Right. All right. Cool. So you buy it for 72 grand. If it goes up the same as all other properties have been going up, you're probably going to be making around about 250 grand in capital appreciation. And the reason we know that is because the house prices double every 10 years. And we know that they do because we've looked at it through history, right?
Yeah.
But even if it's a bit less, let's say it's 200 grand capital appreciation that you make.
Yeah.
Right? So you've put in 70 grand, you've made back 200 grand in capital appreciation. So that means that you're trebling your money in 10 years.
Yeah.
Because you only put 70 grand in, you've made 200 plus grand in capital appreciation. Some people are looking a bit puzzled by that. Let me explain why. You're shaking your head. You're not puzzled. Okay. Not puzzled.
He's just mind blown.
He's just mind blown, right? Yeah. 70 grand in, you 200 odd grand. That's just a random house. That's not doing anything clever. That's not doing a buy refurbish finance. That's not taking into consideration the rent. Yeah. That is literally just buying a random house. It's been like that for 90 years.
And you know what's crazy as well? This is where we say debt can be good. Because in this case, you can use the debt to your advantage, because as the value of the house goes up and it appreciates, the debt still stays the same.
Bang on. And people that are worried about the interest rates, I'm not making any profit. They're not taking into consideration the capital appreciation that they're making.
So here's a question for you.
Go on.
Knowing what you know about the appreciation, when you invest in properties, do you buy based off the appreciation that it's going to have or the cash flow that it's going to make?
It's a good question. I think it depends on what your goal is.
Yeah.
So, for example, if you've got a really good job and you're earning a lot of good money, and you just want to invest the money that you've got, right? Because it's funny, isn't it? Back in 1930, £400 was the house, right?
Yeah.
So someone that bought that £400 house 90 years ago would now have an asset that was worth £250,000. So £400 in 90 years has turned to £250,000. If they put that £400 in the bank, right, that 400 grand back then would have been worth a lot more. Well, I think I looked into it. I think it would be in the equivalent of having like 30 grand, right? So it'd be like you putting 30 grand in the bank today and just leaving it. And now it's only worth £400. That's the equivalent of what you'd do, right? So you've gone from a situation where you've got roughly about 30 grand, keep it in the bank, 90 years' time, it's worth about 400 quid. By the time...
Well, so you're saying if you put 30 grand in the bank now, it'd be worth 490 years?
Well, that's what it was back then. They had £400. That's the equivalent in today's money of about 30 grand. Right? So if they just left that £400 in the bank, what would it be worth today?
30 grand.
No, it wouldn't. Why is it worth 30 grand?
Oh, you've lost me, man.
All right. So you've got, back in 1930, right?
Yes.
When you were just a young boy, right? You've got £400, which
Yes.
back then is a lot of money.
Okay, so I'm rich.
I wouldn't say you're rich.
I'm okay.
You've got 30 grand equivalent.
But 400.
But it's actually 400. You understand inflation, right?
I understand.
Okay.
So have I got 400 or 30? I'm confused. Which one have I got?
All right. Let's say
Right, it's 1930. I walk down the road and I go to the ATM.
Right. Yeah.
I look at the screen. In fact, I go to the cashier at the bank.
There's
I
no
say, "What's the balance?"
ATM. I doubt back then, right? But
So-
maybe let's say there is.
I
Let's
go
say
to the bank and I say, how much have I got? They say, what?
They would say 400. But it wouldn't be like 400 today, because you'd be like, 400, man, that's the equivalent. If I was talking to future Rick in 90 years' time, he'd think that was like 30 grand. Makes
Okay.
sense?
Yeah. So have I got 400 or 30?
You've got 400. You've got 400.
So I've got 400.
But
But I'm acting like it's 30.
because it kind of is.
But do I know it is back in 1930?
Yes, you think, back in 1930, right, you think, I've got 400 quid, I could buy a house with that.
Okay.
Yeah,
All right.
But I'm not going to buy a house with it, because property investing
Yeah.
is risky.
So now what you're saying is today, I've got 30 grand in the bank. In 90 years, it will be like having 400 quid.
Correct.
Right.
Right, you got it now, yeah?
Yes.
So if you had 30 grand today, if you bought a house with it,
Yeah.
if the exact same thing happened, what's happened the last 90 years, the 30 grand today, I mean, forget, if you bought it for cash, I mean, you probably couldn't buy a house for 30 grand for cash, maybe in Hull or somewhere, but let's say you bought it for cash, it would be worth $250,000, or if you left it in the bank, it'd be worth 400. So in other words, basically what I'm saying is, taking that 30 grand today, putting it into property, is going to turn it into 250 grand plus. That's not even taking into consideration leverage, like we just talked about.
Yeah.
Leaving it in the bank in 90 years, it's going to be worth the equivalent of £400 if property prices and inflation carry on the same as they are. So all I'm saying is it just shows the value of investing in property. You know, that is the way to beat inflation. If you just leave your money in the bank, inflation is just chipping away at your money. You invest it in property, it kicks inflation's ass. Even if you're not leveraging and using a mortgage, even if you're not getting great cash flow from service accommodation, even if you're not pushing up the value using BRR, if you just buy a random property for cash today, you're massively quids in.
And this is how people become accidental millionaires.
This is exactly how people become accidental. This is how most millionaires are made in property, by just buying their own house. You buy your own house, you don't even need a 25% deposit. You just need like 10%, right?
Yeah. Interesting.
It's almost like we should be property investors.
Maybe we should.
Maybe we should.
Maybe we should put our £400 into a property.
Maybe you'd be nuts not to, wouldn't you? If you knew, right? If you were back then and you heard, oh, if I get 400 quid, if I buy a property, it's going to be worth
Was a
£250,000.
pound a thing back then? I thought it was shillings.
Shillings is less than a pound, isn't it?
Pounds, shillings, and pence.
Pounds, shillings, and
Pounds,
pence.
shillings and pence. We have someone in the room that was from the 1930s.
I don't know how much of a shilling worth.
It's the equivalent of 5p.
5p. So it's crazy that we still have pence. Do you have half pence as well?
Yeah.
Half pence.
So you make appreciation of that example that we did. You'll make 200
odd grand, 200 grand plus grand, literally in 10 years.
that you need to pay your mortgage back.
Well, that's assuming on an interest-only mortgage. If you're paying your mortgage back as well, then you'd have even more.
No, but some of that appreciation you need to pay the loan if you're on interest only.
No.
If you refinance.
Well, yeah, but your rent would cover your interest, right?
Yeah.
Yeah. Oh, if you refinanced it.
Yeah,
Well,
I'm saying if you were to pull out the equity, you would then pay back the mortgage.
Well, that's the other brilliant thing about property investing as well, right? So if you refinance it, you don't pay tax because it's debt,
Yeah.
right? Where else could you earn 200 grand and not pay any tax on it?
Maybe we should invest in property.
We definitely should invest in property. I think that's the lesson here. But it's just interesting because you only know, when it moves slowly. Like if we look, for example, back to say when we sort of started getting interested about 2010, right? Just before. So you can see property prices were about 167 grand. So it doesn't feel like they've gone up like loads since then, like with everything else. And you just thought, oh yeah, I suppose it has. Yeah, it's 256 or whatever now. Gone up probably a bit more since 2020. But you're just like, oh yeah, when you're in it, you don't see. It's like when you lose weight and you don't see it every day.
I don't know
you
much
wouldn't know
about
that. It's like when you put on weight.
Oh, I know a lot about that. Tell me about that.
So when you're putting on weight, you probably on a day-to-day basis, you don't realise. It's only when you sit back and have a look and you see the, I don't want to call it progress, but you see the sort of the girth expanding, and you're like, wow. And I look back at pictures of me a year ago, look how fat I look, but I don't notice on a day-to-day basis, right? And it's the same. It's because it's slow, we don't kind of realise. But when you stop back and look at it, it is nuts. Isn't it?
You started getting involved in property in what year?
About 2010.
So what the properties that you got in 2010, what have you got equity in them now from that appreciation, or have you refinanced them? What have you?
I've refinanced
and pulled out the money.
Pulled out the money
and reinvested the money.
Correct.
So in the next 10 years, will you refinance again? Okay. Will you just keep on refinancing?
100%.
Do you think you'll ever sell any of the houses?
I wouldn't say I would never. It depends on my strategy. So at the moment, we're buying hotels and things like that. So it might be that I wanted to pull money out to do something else. But I don't think so. No, I don't plan to.
Here's an interesting question for you.
Go on.
So we look at this appreciation over 10 years. When doing buy, refurbish, refinance, I speak to a lot of people and they say, buy, refurbish, finance, buy...
Can they speak when you speak to
them? No, maybe we shouldn't invest in property. Can't even pronounce the strategies. Buy, refurbish, refinance. That strategy is good at the moment because house prices are going up. But from my point of view, I think when you're doing buy, refurbish, refinance, I don't think it matters if the price is going up or down. I don't think it matters what the market's doing with that strategy.
It depends. I think it does matter if you're highly leveraged. So, for example, if you're bridging, and you have to pay the bridge back, and you need the property to go up to pay the bridge back, then it does matter, right?
But you're forcing the value up, though.
Yes, you are. But if they're coming down, surely it matters to a point.
Yeah, but how much a house price? If you factor in that contingency, really, the average buy refurb deal will take a year. So if you factor in the contingency and you get it below market value, factor in what it could go down within the year, why would it matter?
Well, if you factor it in, what it could go down, then it wouldn't. But it would be beneficial to you if it went up. If your plan was to refinance,
of course it would be. But it's only a year, isn't it?
Tell you what I do think. I do think you kind of can't go wrong, because even if you messed it up, right? Even if you totally messed up your buy, refurbish, your finance, you bought it, you did it up, and it was worth the same as what you'd spent on it, just a bit of time, and it's going to be worth more anyway. You're almost doing just by waiting 10 years, it suddenly becomes a BRR, even if you didn't do any refurb.
Yeah, but your money's then tied up, isn't it, for 10 years?
Yeah, but it's going up in value. Who cares?
Because you could find a good buy refurbish deal.
That's better.
Pull your money out.
But what I'm saying is, I'm agreeing with you. If let's say you bought it, refurbed it, and house prices dropped, and it ended up being just worth what you paid for it, then just wait, and then refinance.
So don't wait to buy property.
No,
buy property and wait.
100%.
I'm sure we said that quote before.
I'm sure you have. But yeah, 100%. If you just want to get in now, and even if they're dropping or they do this, people get scared, but they are massively going up, and it's been proven. The last 90 years, doubled every 10 years.
So what would your argument be then? Someone that's like, well, you could say that about anything, couldn't you? Say it about gold, stocks, put it in that and just wait. So why is property different?
Well, when I look at things like gold, I think what I like about property is how consistent it is. When you look at gold, it kind of will shoot up, and then I think it was from 1980s, 2000, it actually went down over a 20-year period. Yeah. And it's a bit more up and down. With stocks, I would encourage investing in whatever. I know and like property, and I look at property, I think you get paid 3 times, it's going up. Warren Buffett invests in stocks, and he's doing all right. He's doing okay.
He's doing all right.
I'm not going to criticize it and say don't do that. I would do what you know. If you know stocks and you make a lot of money from stocks, keep doing that.
Yeah.
If you know property, I think property is the best. You look at the Sunday Times rich list and the vast majority, I can't remember what percentage it was now, but something like, I think it's getting close to 40% of the people that are on the Sunday Times rich list of the 1,000 richest families in the UK make their money in property.
I think a lot of people wait to invest in property as well because of the house prices going up and down.
Yeah.
So a lot of people, Samuel says it at the crash course. At the crash course, Samuel says house prices go up, and when they go up, everyone gets excited. And they're like, oh my goodness, the houses are going up, I'm going to buy, they're going up. Then they go down a little bit, and everyone's like, oh, I'm not going to buy now, house prices are going down. Then they go up, and everyone gets excited. But then before they buy, they drop again, and people wait. And then before you know it, 90 years on,
yeah,
you regret not doing it.
I think the key is buy to hold, never to sell, refinance to pull your money out, keep them. They're always going up in value.
So I'm really interested in this, actually, to get your point of view. I know we spoke about it a minute ago,
yeah,
but you and Samuel say never sell houses. Obviously, certain circumstances, like when you're doing your development deals and stuff, it's more beneficial to sell them and stuff. But generally speaking, it's like never sell, always refinance. So are there any scenarios you can think of, or what would be the reason that you would sell? And what's the reason for holding it instead of selling it?
Yeah, there are certain situations where you could sell. So, for example, like you mentioned, development. If you're doing development and you wanted to pull all the money out, it might be that you need to sell some of the properties to do that, and you want to reinvest it and do more development, so it might suit you in that situation. It also might suit you if you wanted a trading business, if you were doing, for example, inheritance tax planning, and you were planning on leaving businesses to your children. It might make sense to have a trading company that sells part of their assets. So there are certain advantages in certain situations. However, for the vast majority of people that are looking to get into buy-to-let or looking to become a landlord and buy property, I would recommend buying properties. Don't sell them. Wait for them to go up. Don't sell them when they go down. That's the worst time to sell.
Yeah.
Wait for them to go up. We know they're going to go up, and then refinance, pull your money out, keep going.
When you do buy, refurbish, refinance, and you do developments, how much do you factor? Let me try and word this so it makes sense, because I'm not quite making sense today. I'll do my best.
Go on.
How much do you factor in appreciation when you're doing buy, refurbish, refinance on a small deal that's going to take 6 months to a year? And do you factor in on development deals that are going to take maybe a couple of years? And if so, if you do both, how much? Do you factor in the same percentage margins for the appreciation for each one, or how do you do it?
Yeah, I actually don't factor it in. So I look at every deal in its own right. So I look at a BRR and look at what it would be worth today. And then for me, the capital appreciation is just a bonus. In the same way, when I'm buying properties to hold, what I'm actually looking at normally is, if it's a BRR, I'm looking at how much I can make from it immediately. I'm not taking capital appreciation into consideration. But often I'm looking at the rent. So I'm looking at how can I rent this out? How can I make as much profit? You can't control the capital appreciation. So from my point of view, that is a bonus. I know it's there, and I'm gambling on it because I'm looking at history and I've seen it's gone up. But I'm investing for other things like cash flow, like how much value I could add, and then the capital appreciation is just a happy coincidence that happens with every property, and I will take it when it comes in.
Yeah, and I think an interesting thing as well is that a lot of people, I was the same 5 years ago when I was thinking of getting started in property. I used to think, the country's all one place where the market's going up and it's going down. But what I realised was, when I was watching Samuel, it's almost like every city has its own economy. Every city is in a different stage of going up in value and going down and having appreciation and depreciation.
Yeah, they go up at different times, but they all go up.
And they all follow the capital.
London tends to go first.
Yeah. So do you choose what area you're going to invest in based off that information?
Not really.
No.
Not really, because if you look at it, it's on average across the whole country. They all people say, "Oh, London's great for capital appreciation," but in reality, London just gets it first. But everywhere follows suit anyway.
So what would your advice be to someone? What would you say to someone that, because I get this a lot when we're at crash courses. People come up to me and they say, "I'm really worried at the moment because house prices are going down. I'm a bit fearful." What would you say to someone that's thinking, right, I want to get into property, I want to get started, but now's not the right time because of what the housing market could be doing?
People say it to me and they say, "Oh, what about the house crash?" And I say, "Look, we've seen house crashes before. What about the wage divide? Wages aren't good. We've seen it." I can't remember what decade it was. I was looking when I was studying this, but I think house prices at the time were like $6,000. and salaries were like $1,000 a year. So there was 6 times the salary, which is kind of like what it is now. We've seen it all before. It's all happened before. We can see it throughout history. So yeah, the housing market doesn't go like this. We know that. If you're listening to this podcast, you won't have a clue what I'm doing. But I'm pointing my finger up in a straight line, right? It doesn't go like that. It goes up in little bit, then down a bit,
And
then
just
up
for
a
the
bit,
podcast
then
as well,
crashes.
he's moved his hand up, he's moved his hand down. So
Yeah.
I can't commentate for the podcast, but I don't think that went down well. Sorry, he wasn't moving his hand up and down and up and down. It was pointing. He was pointing. So what you were saying was. So what you were saying was.
Please go and watch this on YouTube.
So what you were saying was.
Yeah.
Your hand doesn't go straight up; it goes up and down.
It goes up and down and up and down and up and down, but mostly
But
up.
it ends up. Well, I can't wait to pick up this conversation in 10 years with you and see how the house prices are doing then.
Well, I'm excited, bro. I'm excited. And we'll look back and then we'll be wondering what they're going to do for the next 10 years.
Maybe they'll be up.
Or maybe they'll be down. Who knows? Anyway, I've been Russell Leeds.
I'm Ricky Mandal.
See you next week.